Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for October 7, if you can believe it or not. It's episode 357. I'm Dean Croak, market analyst here at DAT. Special guest, been waiting to have Bill on for a long time, Bill Cassidy from the Journal of Commerce. Bill, great to have you with us.
Great to be here, Dean. Thank you very much.
Yeah, missed you at the Inland Conference. Of course, I wasn't there, but you missed it for the first time, I think, ever.
First time ever, but hopefully I'll be back in the saddle, as they say, next time around.
Yeah, it's good to have you with us. I don't know many other folks in the trucking industry that span as many freight cycles as you do, but that's sort of a topic of conversation today. For those that don't know you, we were joking off air that there can't be many that haven't followed you for years. But for those that don't know Bill Cassidy, tell us a bit about what you do at the Journal of Commerce.
Sure. I'm the senior editor for trucking and surface transportation, domestic transportation. I've been doing that since 2009 for the Journal of Commerce, but I joined the group back in 1996 as an editor at Traffic World, which was a weekly publication that the Journal of Commerce used to own and was merged into JOC back in 2009. But my trucking coverage goes all the way back to really the 1980s when we got a job with McGraw-Hill in New York, working for a magazine called Fleet Owner, which many of your audience will know. It's still being published today. Worked for Fleet Owner, worked for Transport Topics before coming to Traffic World and the Journal of Commerce. So it's a lot of years and a lot of water under the bridge.
Bill, Journal of Commerce must be, what, 150 years old?
Almost 200.
Almost 200. Wow.
Yeah, the publication was founded in 1827.
Goodness me.
So we're in our 198th year, looking forward to a big celebration in 2 years when the 200th anniversary comes up. And founded in New York City at the time when the clipper ship was just getting under sail, and canals were still big news in the United States.
Right.
So a very different time, but the Journal of Commerce has continued covering transportation and trade.
What year was that?
Since 1827.
1827. Wow.
Mm-hmm.
Gee, it's a long time ago. Probably right around the time my fifth great grandfather was being shipped to Australia as a convict. That's another transportation story for another day.
That'd be a good one.
Yeah, absolutely. All right. So, Bill, we'll bring you back in a bit later and talk about some of these freight market cycles. We'll dive into the freight market and some of the trends we're watching here, and then we'll bring Bill back a bit later. All right. Some of the major trends we're watching, lots of news this week. Spot rates up at the end of the month. Of course, it was a little bit unusual. End of month occurred sort of on a Monday, Tuesday this time around. So I think that was part of the reason we saw rates go up over the course of 2 weeks, but no great shock there. But the gap towards last year, as we look back, has started to widen over the last couple of weeks. So it's an interesting trend, especially in flatbed. We're watching that one closely. Of course, the surge in data center construction over the last couple of years is really driving flatbed demand, especially for specialized over-dimensional loads. That's something Bill and I'll talk about vis-a-vis the parallels between this year and 2017. Spot rates in flatbed are trending in the order of 3 to 5% higher year over year. So we'll look at that one a little bit later. ISM came out last week, the Purchasing Managers Index, up slightly to 49.1%. New orders, however, came in a little bit weaker, falling back into contraction territory at 48.9. New orders, according to ACT Research, the longest for-hire downturn in history, continues to weigh on truck demand. Freight rates continue to run below inflationary levels, according to Tim Benoit. Class 8 truck orders total 20,800 units in September, down a whopping 44% year over year. According to Standard & Poor's, of course, of which Journal of Commerce is part of, September imports, according to our peers database, plunged in September, down 11% month over month and 9% year over year. Of course, no surprise after the July record levels of imports. Imports from China down 13% month over month and almost 20% year over year. In Los Angeles, where in a typical month, 50% of imports come from China, Imports from that nation fell 17% month over month and 30% year over year. All right, let's start off with some of our equipment types. In dry van, our market condition index showed some interesting trends last week linked to the fall in imports on the West Coast. Load to truck ratio nationally end of the week at about 7.67. On the West Coast, there were some capacity imbalances caused by the fall in imports. Brokers faced some capacity challenges in California, particularly the Stockton market, which is the recipient of a lot of imports out of Los Angeles. Load posts in California were up about 20% week over week. This was due to a decrease in trucks arriving in the Stockton market in particular. You see a lot of capacity move between Los Angeles and Stockton every week. There was a 10% decrease in the volume of loads moving between Los Angeles and Stockton. It's one of the high volume lanes. One of the reasons for that is the 17% drop in import volume from Asia into the Los Angeles market. So obviously there was less volume moving north out of Los Angeles to Stockton. That caused an imbalance in trucks moving north to Stockton. That caused an imbalance in freight, of course, imbalance in capacity moving south back to Los Angeles. There was also an imbalance as a result of that drop in freight, trucks moving to Las Vegas. There was an imbalance there, so there was an increase in load posts coming back out of the Las Vegas market. There was a 45% surge in outbound load posts in Las Vegas. Brokers were looking for trucks, so there was a surge in tightness of capacity outbound that market. So we're seeing some capacity imbalances as a result of the drop in imports. Also in the Midwest, there was a tightening in capacity in Chicago. Load posts jumped 20% last week. Rates up about 8%, 8 cents per mile, averaging about $2.20 for outbound shipments. So capacity's been tight in Chicago for a couple of weeks also. All right, refrigerated market, load posts saw a slight increase last week. Equipment posts down slightly, load to truck ratio sitting at about 13.48. Brokers saw some regional capacity tightness, especially on the southern border. Even though it's the low point in imported produce from Mexico, we're seeing some load post surge in Texas, southern Texas, up about 15% week over week, largely because, and this again is anecdotally, because of the enforcement activity by Immigration and Customs Enforcement, colloquially known as ICE, been very active along the southern border. Outbound McAllen reefer rates up 3 cents a mile last week, but up 16 cents a mile on the 1,600-mile haul from McAllen to Los Angeles. Of course, Los Angeles is the source of a majority of capacity in that southern Texas market. Of course, California carriers are reluctant to head east to load produce back west, so reefer rates are going up. Same effect in neighboring Laredo. Reefer rates up 8 cents a mile last week, but up 17 cents a mile for loads to Portland. Of course, no coincidence that we're seeing increased enforcement activity there also. Closer to Los Angeles, a similar story played out in Tucson, where capacity was also tight in Nogales. Spot rates surged 25 cents a mile there. In flatbed, last week, load to truck ratio climbed to 30.02. Brokers also reported some significant capacity constraints on the southern border, particularly Laredo to Houston. Load posts were up almost 30% last week. Laredo is, of course, the busiest inland port in the United States for truck traffic, handles more commercial traffic crossings than any other port of entry, and is also going to be the most affected by ICE activities. Again, similar effect there to reefer and dry van. Laredo to Houston, spot rates jumped 12 cents a mile to almost $3 last week on a 17% lower volume of loads moved. Dallas to Fort Worth, Metroplex out of Laredo, rates rose 3 cents a mile, paying carriers an average of $2.62. And of course, in Miami, which has been the epicenter of a lot of ICE activity, load posts are up 24% week over week. Outbound spot rates up 8 cents a mile on a 16% lower volume of loads moved. All right, lastly, let's have a look at our year over year look at spot rates on the chart there. You can see some of our more recent years, excluding the pandemic years, which clearly have been outliers given some of the volatility we've seen. In dry van, spot rates were up 3 cents a mile last week. This is our 7-day rolling average, excluding fuel. They are up 3 cents, averaging $1.70 per mile, up 5 cents over last year and 11 cents over 2023. On our top 50 lanes, rates are up 3 cents, averaging $2.01. In our 13 key Midwest states, rates are up 5 cents, averaging $1.92. Having a look at our refrigerated market, end of month rates for the 7-day rolling average up 5 cents, averaging 205. They've been mirroring the last 2 years for quite some time. In fact, up to the last 2 or 3 weeks, they've been tracking very closely, now up about 8 cents compared to last year, and a clear 15-cent per mile separation over 2023 as we head into the traditional seasonality that we see early November, when we start to see fresh turkeys, hams, Christmas trees start to move. So expecting a little bit of volatility in the reefer market here in the next 4 to 6 weeks. In the flatbed market, and lastly, rates experienced a modest increase last week, just a penny per mile, up to 207. It's about 8 cents a mile higher than last year, sitting about 17 cents a mile. As you can see on the chart, 2025 rates continue to track very closely to 2017. Of course, that was a year marked by a strong industrial economy. And as Bill reminded me on Friday, it was also a year we had 2 Cat 5 hurricanes land in September. But we are carefully observing this trend, as its consistency suggests more than a mere coincidence. We believe the AI-driven data center construction boom is likely a significant factor in the heightened demand for open deck carriers in the spot market. Let's have a quick look at our short-term forecasts. According to Ratecast, in dry van, rates are expected to flatten out towards November 7, flattening out sort of more towards Halloween, and then really by the time we get to November 7, down 2 cents a mile at $1.68. If they land about there, they'll be still up about 2 cents according to last year's rates. Low case has rates down 6, high case up 2. So I think that'll be pretty accurate at $1.66 by the end of the 35-day forecast. In the refrigerated market, of course, you're now starting to see the Ratecast pick up the early November sentiment, where we start to see rates lift. I do think the uppercase forecast here is going to start to reflect some of the volatility we're seeing in the market. I wouldn't be surprised to see the uppercase forecast of rates up 8 cents a mile by the time we get into that first week of November start to become a reality. We're starting to see some real tightness in the market as capacity exits and some of the enforcement activity starts to affect the market. I think we're going to see some real rate volatility anytime there's a surge in spot market demand as this market gets into this seasonality early November. So reefer rates, according to Ratecast, out to November 7 at about 204, pretty much exactly where it was this time last year. And lastly, in flatbed, expecting rates down 4 out to November 7 at $1.94, pretty much exactly where it was this time last year. All right, let's bring Bill back in. Bill, question of the week. How much of a role is technology playing in flattening out freight market cycles?
I think it's playing a big role, and I think it's a role that has largely taken place behind the scenes to an extent, because it's not the first thing we think about when we think about market cycles. We think about capacity, the number of drivers in the market, the number of carriers exiting the market or entering the market. But, something you mentioned very early on, the truck ton miles index from Michigan State and Jason Miller, it is up slightly. It was up slightly in the last reading, I think, which was for August. But what strikes me there, it is different from, say, the Cass or other indexes that focus mostly on the for-hire market, as the ton miles index. I think we're picking up on some increase that is outside of the traditional, say, for-hire truckload area. Possibly from private fleets. And, as I've been hearing from people lately, private fleets aren't really suffering a freight recession.
Right.
So I think that, looking at that bigger picture, the market cycle looks a little bit different. But part of the reason for what I see as increased use of private fleets by shippers is the fact that shippers are using technology today that allows them to drill down lane by lane and decide how they're going to move freight in a way they couldn't do 10 years ago,
Mm.
like before this cycle, really. So they're able to look at a certain lane and say, okay, in this lane, we're going to use our for-hire carriers, and we're going to put more freight onto the spot market. In this lane, we're going to use our private carrier.
Mm.
In this lane, we're going to use brokers. I think it's a much more fluid situation than it was in the past because shippers have more data now. As someone said to me, everybody has APIs now, and they're all connecting to TMSs. So everyone's using their transportation management system to do, quick rating, instant rates. These are things that they couldn't really do, say, in 2014, 2015, that they're now able to do. And that, I think, helps. Number one, it helps them create competition where there was none before, which keeps lowering rates. And it also helps them, to an extent, create their own capacity in a way that didn't happen before, which meant that they could keep rates at, capped at a certain level. So I think that really is happening out there. And I think it's only going to get more interesting as we go forward into the artificial intelligence age. And also, there's an article on the JOC this week by my colleague, Eric Johnson, looking at, coding and how, more and more tools are becoming available to allow people who aren't technology wizards, who aren't programmers, to go out and do their own coding and create their own software. That's going to challenge these software as a service providers going forward, perhaps. So I think there's going to be even more of this going forward. And yeah, to an extent, it probably does flatten out the volatile peaks we're used to seeing in the typical truckload cycle.
So let's put some dates around it. You mentioned 2014. I remember when I started at FreightWaves in late 2017, and we started the Sonar Tender Volume Index. So we benchmarked it in the start of 2018, first 3 months of 2018, if my memory serves me correctly. And we were talking, I remember going out doing a presentation to some shippers, and I was presenting what the freight market looked like in early 2018. And I got a lot of blank stares. And it was like I was describing a different freight market to the shippers. And I kind of went back to the office and I told the guys what the reaction was. And it was like I was describing a different freight market to the one the shippers had been described to by their carriers. Because I was describing a more transactional, real-time, near-time market than the one they'd been led to believe. And it kind of struck me that, and someone said, yeah, but the shippers are always the last to know. And I kind of thought, oh, really? Because I was fairly naive. I'd come from the telematics world, and it was kind of my first exposure to the freight side of the market, because I was always deep into the data and the safety side of the truckload market. And it struck me that they hadn't really been deep into the transactional data side of the world. And I wonder if and of course the pandemic really accelerated technology adoption, but I do distinctly remember 2018 as being a period where a lot of large shippers got caught with the surge in spot market rates. And I really remember the last part of 2018 where a lot of large carriers, a lot of large shippers in that fourth quarter saying their earnings calls, they had to take a hit because they underestimated the cost of transportation, and in their earnings calls, they had to take a large loss because of the cost of transportation. People were losing their jobs, et cetera, et cetera. So I wonder if that was sort of the start of, we need to really understand transport and logistics and develop better tools so that we don't get caught again. And then, of course, the pandemic happened, and we had double-digit rate increases for multiple quarters. I wonder if that was really the start of this. What's your take on that?
Yeah, I think it probably goes back even a little bit farther. I mean, we were talking about 2014, 2015. that to me seemed much more like the typical period or cycle where you went from, a boom to a bust. And
Right.
suddenly, I mean, I had many shippers at that time, like say in 2015, 2016, tell me, it doesn't matter what we have done with our carriers in the previous 2 years, 3 years, all the programs we've built that were tailored to our needs, which added cost for the carriers, those are out the window
Oh, really?
because we're
Right.
being told by our procurement people, you need to get a 10% discount, a 10% reduction in
Right.
rates.
Right.
That's it.
Right.
So, you know, I think that kind of swing or that kind of negotiating approach, if you want to call it that.
Started then.
Yeah, it was there then,
Right.
but I think that it was probably, again, they were painting with a broad brush.
Hmm.
Um, because they didn't have the data that they needed to do a more targeted approach to
Right.
how they address
Hmm.
pricing, how they
Hmm.
address capacity. Um,
Hmm.
you get into 2018 and you described what we saw then. And then, of course, 2021
Hmm.
to 2022, you had, multiple quarters of double-digit rate increases. We saw, we can look at any chart from that period and see how quickly the mountain rose, right?
Right. Yeah.
Uh, so they were really shippers who, after 2018, said, "Well, I'm glad that's over, never again." Were
Right.
hit 2 years later. So I think that has left deep. I guess you could call them scars. Is
Yes.
sort of the best word, but that's
Yeah.
left a deep impression
Yeah.
upon shippers. And now you're in this period where it's 3 years into a freight downturn
Mm.
in which rates have come down substantially. Um, do we hear the same kind of discussion that we heard back in 2016? I think it has changed.
Mm.
I
Mm.
think it has changed. And I think it's changed because, again, partly because shippers do have the technology and the insight into data that they need that didn't have back 10 years ago or
Mm.
even 5 or 6 years ago. And it's giving them, a in addition to the market being in their favor in general right now, the technology is giving them a greater advantage.
Mm.
And I mean, carriers are using technology as well to their advantage, especially in terms of cost management. Um, I am often reminded that, especially when it comes to some of the large carriers, whether in truckload or in less than truckload, they've got more data about their customers than their customers have in many cases.
Mm.
So I think overall the technology that's available today is lengthening the cycles,
Mhm.
flattening the cycles a bit. Um, and that's probably right now putting more emphasis on other things besides where's my capacity going to be in 6 months.
Mm.
Um, I think shippers are still really concerned about what's happening with tariffs and with the trade policy.
Yeah, they are. Yeah. I think we're seeing, it's interesting. I think we're about to see, I mean, I feel like banks have continued to support carriers, but, I really do feel if the finance side of industry continues to tighten or starts to tighten, we may see the capacity side of our industry start to tighten. I really feel like there's been a safety net put under a lot of carriers, especially smaller carriers, that will weaken the capacity side of our industry. Um, but that remains to be seen. There's definitely, I do see signs in the spot market, Bill, that capacity is starting to exit at a faster rate. And at some point, this excess capacity we have to get to a point where it's no longer sustainable. And if you listen to some of the the undertones from some of the more recent meetings, there's some pretty dire warnings coming out of these meetings from large carriers that they're talking about, things that I wouldn't have thought carriers would be talking about publicly. So I think things are much worse on the carrier side than what they're letting on. And that has to be alarming for shippers to hear those sorts of things. On the spot market side, we see signs of equilibrium, because every time we see a surge in demand, we see a surge in spot rates, and then they sort of come back down. So that tells me that when we see a surge in activity around Thanksgiving and Halloween, and peak season around retail replenishment heading into holiday season, spot rates are going to surge. Or if there's a hurricane, we'll see. That tells us that it doesn't take much to flip this market. Now, add into that English language proficiency, or add in non-domicile CDL enforcement, and if there's a sufficient number of drivers that now need to get H2B or HDA visas, assuming there's a lot of drivers that have crossed the border and have an I-94 card that's going to expire. I don't think there's many of those, to be honest, but let's just assume there's some. That'll all have an effect. Timing-wise, though, Bill, we're heading into a quiet quarter in the start of the year.
Right. I mean, it's. I think that the $1 million question, or maybe it's the $1 billion question, to put it in 2025 dollars, is how quickly will capacity exit the market? You're saying you're seeing signs that capacity is beginning to exit more quickly, but is it going to be a long trail, a long drain that we see over, say, 4 to 6 quarters? Or is there a sign that there may be a cliff out there that we are going to hit and suddenly we'll have tight capacity? I mean, I personally believe that demand has to lead. In this case, we need to see an increase in demand if we're going to see a great tightening of capacity, or a faster tightening of capacity. The problem is there's not much of a catalyst for that demand right now. So, it could very well be that we will see a long trailing off of capacity.
I think you're right.
Yeah, which means we don't see
Correct.
We don't see that sudden correction as we saw, the kind of thing we saw in the fall of 2017. If we had 2 major hurricanes this season,
maybe
in September and October, that would perhaps have changed things. But knock on wood, we're not going to see major hurricane this season. We've been lucky. So it's extremely quiet right now. There's no major port strike in the offing.
And despite all the geopolitical activity and that would suggest diesel prices should be rising on the back of crude oil prices rising, they're remarkably flat.
Yeah.
So that's the only thing that would, I think, cause an exodus of capacity is diesel back up over $5.50 again.
Right.
So there's a lot of political reasons, I think, why diesel is being kept fairly low. So that would be the only thing that would cause capacity to be, in the spot market in particular, the marginal capacity to be flushed out of the industry. So I think it'll be a slow process again. I think you're 100% correct.
One thing I'm interested in seeing is what we get from the large truckload carriers in the third quarter. I do our Journal of Commerce truckload capacity index, which looks at truck counts at large publicly owned companies. So it's totally different from the long tail of small carriers, but it's the large truckload companies hauling large volumes for large shippers. And it dropped precipitously like a cliff from mid 2022 right through the first quarter of 2025. It actually dropped as far in that period as it did from early 2008 through 2014.
Indeed.
So like a 6-year period was compressed into a 2-year period, which gives you a sense of how steep that drop really was. And then it bounced back a little bit in the second quarter, which I've had interesting discussions with people about, because some people have called me and said, well, our data shows it going down a little bit further. And, well, maybe it is, that's their data. This is my data.
Yeah.
But whether it's up 1% or down 1%, that's not a huge
Mm,
difference,
mm,
really.
mm,
I, th- I think it did show that, perhaps there is a bottom there.
mm.
But the question is, will we see that go? Will we see that drop again as we go into the third quarter, as carriers begin to suspect that they're not going to see that much of a pickup in demand come the first
Right.
quarter or the
Well,
second
I
quarter?
think you'd be prudent to budget on fairly flat demand leading into the first quarter, knowing that first quarter has already been benefiting from a pull forward of inventory earlier this year anyway. So I think you're going to see carriers are on the side of caution there, Bill. So that's why I think you're going to see fairly flat demand for the foreseeable future and a fairly slow um, exodus of capacity over time. Our forecast for rates is very flat to maybe very low single-digit increases on contract and spot. So not a lot of change in this market over time, which is not necessarily good news. But I think when carriers like JB Hunt, Werner, Sam Anderson at Bay and Bay at that FTR event recently talk about a very bumpy 12 to 18 months, I'm quoting here, and 2027 mentioned as a recovery year, that's sort of fairly interesting, comments and words being mentioned there that I hadn't even thought about mentioning. 2027 as being a recovery year.
Yeah.
That's fairly interesting.
Yeah. Well, I know the more forecasts I see, I mean, C.H. Robinson
Mm,
in its August forecast, I think had spot rates up 2% by the end of
mm,
2026.
mm,
Arrive Logistics in their most recent forecast says 6% for spot rates, but 2% for contract rates.
mm.
And I know that the carriers in negotiations right now for their 2026 contracts do not want to hear. Well, they're finding that 2% is probably not bad right now
Mm.
in this market,
Yeah.
because what we heard last week at the Inland Distribution Conference, although I was not there, I did hear a lot about it. Um, Shippers, number one, remember the word mini bid?
Yep. Right.
That's been stricken from their vocabulary.
Right.
Uh, no one is interested in mini bids. I think the shortest bid right now, from what I heard from the conference last week, is about 6 months.
Right.
But usually, people are looking at annual bids,
Right. Right.
and and at the most, they're looking at low single digit
Right.
increases, if not
Right.
flat to
Right.
down
Right. Right.
slightly on their annual contracts. So
Mm,
that is not what those large carriers, I think, were hoping for. So
mm,
it wasn't what they expected last year either. So
mm,
it's
mm.
they're seeing it's Groundhog Day for them. They're seeing
Yeah.
the same ideas come back a year later,
Yeah.
and where they had warned last year about capacity tightening and were proved wrong, I think they're having a harder time selling to their shippers this year that, 2026 is going to be the big year that's going to change.
Yeah. Yeah.
Um, but uh,
Yeah.
but yeah, 2027, FTR did say that they expect 2027 to be the
Right.
year when the excess capacity finally is no longer there.
Yeah.
That active truck utilization will go above 94%
Right.
when you get into 2027, and that just seems like an awful long time to
Doesn't
wait.
it?
Yeah,
Doesn't it? It's a long way off.
yeah,
Yeah, this is fascinating discussion. What a time to be alive. And of course, Jeff Bezos is talking about AI data centers in space. And so,
but you can't get a flatbed to the moon yet. I mean, that
no,
is one problem.
but apparently the sun's hotter and yeah, like there's more. Like this is wild. Just when I had my head wrapped around all of the data centers and flatbed demand for data, terrestrial data centers, he starts talking about in the next 30 years we'll be building data centers in outer space. So pretty wild times. Bill, thanks for being on the show. This is fantastic. Yeah, I think we're onto something here. Talking about everyone on all sides of the transaction having access to largely the same data. I think there's something think Andrew Smith from Circle Logistics, I think it was, said that flat is a thing, market cycles are for wishful thinking. I think he was 100% correct a few months ago on LinkedIn. I think he was right. So we'll keep in touch. Love reading your content. If people want to get in contact with you, how would they do that?
Best way to do it is to write to me at bill.cassidy@spglobal.com. S&P Global. It's just SP Global in the email address, but that is the parent company of the Journal of Commerce, as you mentioned earlier. Originally Standard & Poor's, going back, and McGraw-Hill.
Right.
But if you write to me at that address, you can get a hold of me easily there.
Yep.
And you can find my work on joc.com. And
Great read.
it's the best place to find me.
Absolutely. All right. Thank you, sir. A couple of shout outs. Don't forget Rogan Radio on Radio Nemo every day on iHeartRadio, Facebook, YouTube Live, 7 a.m. Central. I'm on there regularly with Jimmy Mack and Lindsay Lawler, 7 a.m. Central. Tomorrow I'm on with Dan Deegan, Logistics Life. Chris Kapelis is talking to Ari Ash from the Journal of Commerce, talking about the Transcon Railroad Merger Networks on the Freightvine podcast. No show next week. Make sure you set up alerts to our live shows, subscribe to our channel. With that, another show is in the books. Be safe, be nice. Thanks for watching. And we'll be back here again in 2 weeks, 10 a.m. Eastern, 7 a.m. Pacific. Thanks for watching, everyone.